You log into MyGov. The little green ATO logo stares back at you from the screen. To most Australians, this is just a portal, a digital chore, a once-a-year panic in late July where you desperately dig through your Gmail trying to find a receipt for a $40 work uniform. But it's not just a portal, it is a mirror. It is a perfect mathematical reflection of your exact position in the Australian class system. The Australian Taxation Office doesn't just collect your money. It categorises your life. It dictates your stress. It determines exactly how much freedom you are allowed to have. Today, we are going to climb the ladder. We are going from the crushing gravity of $30,000 a year all the way up to the total, deafening silence of $5 million a year. At every single level, the psychology changes. The physical sensation in your chest changes, and the financial mechanics you must use to survive change completely. This is how the system sees you, and this is exactly how you beat it. Level 1, $30,000. The invisible man, you are invisible. To the ATO, you are a statistical rounding error. At $30,000 a year, money is not a number on a spreadsheet. Money is a physical, violent sensation. It is the tight, metallic knot in your throat when the Woolworths EFTPOS terminal says, "Processing," for 2 seconds too long. Your card declines on a $12 pack of Huggies diapers. The cashier politely looks away. The teenager behind you sighs. You feel a hot, prickling sweat break out on the back of your neck as you quickly open your CommBank app to transfer $15 from a savings account that is supposed to be for emergencies. Every day is an emergency. You do not invest, you survive. When tax time comes, you are actually excited. You pray for July. That when $200 tax refund isn't a strategic capital injection. It is a lifeline. It is a set of new brake pads for your 10-year-old Corolla so you can safely drive to a job you hate. The escape mechanics. At $30,000 you cannot budget your way to wealth. Do not clip coupons. Do not track $4 coffees. It is mathematically irrelevant. The Australian tax system actually protects you here. Thanks to the tax-free threshold, $18,200, and the low-income tax offset, LITO, your effective tax rate is practically zero. The ATO is ignoring you. Your only focus right now must be drastically increasing your market value. You do not need a tax strategy. You need a skill stack. You need to leverage government-subsidised TAFE courses, acquire a high-income certification, and aggressively jump out of the wage-taker bracket. You must force the system to acknowledge you. Level 2, $70,000, the illusion of the middle, you did it. You got a good job, you have a salary, a lanyard, a branded Yeti mug on your desk. But you feel poorer than you did at $30,000. Why? Because you have entered the machine. You are now the battery that powers the Australian economy. At $70,000, you are hit with a psychological weapon, the payslip reality check. You sign a contract for $70,000, but every fortnight, a massive bleeding chunk of your labour is automatically severed by paid withholding. You never even see it. Then, the HECS-HELP debt you took on to get this job starts quietly skimming your take-home pay. Enter your colleague, Brendan. Brendan sits one desk over. He makes $75,000. Brendan just signed a novated lease on a $65,000 Toyota Hilux that he drives exclusively on paved suburban roads. It lowers my taxable income, mate. Brendan tells you in the break room, stirring his instant coffee. Brendan is a financial hostage. He is financing a depreciating liability to save a few $1,000s in tax, chaining himself to this cubicle for the next 5 years. He feels like he is winning a game that he doesn't realise he is losing. The escape mechanics. At $70,000, your biggest leak is lifestyle inflation masked as tax minimisation. Ignore the novated car leases. Your escape hatch is the first home super saver scheme or basic concessional super contributions. By voluntarily sacrificing a small portion of your pre-tax salary into super, you drop your taxable income from the 32.5% marginal bracket down to the 15% superannuation tax environment. You immediately arbitrage the ATO for a 17.5% guaranteed return. You use this to quietly build a deposit inside the ultimate tax shelter while Brendan polishes his Hilux. Level 3, $120,000, the squeeze. You broke 6 figures. In 2010, this meant you were wealthy. Today, in Sydney or Melbourne, it means you can afford a modest mortgage, an electricity bill, and a mild panic attack. The ATO is no longer ignoring you. The ATO has its hands tightly wrapped around your throat. You are a prized cash cow. You earn too much to receive a single dollar of government support, but you do not have enough capital to use advanced tax structures. You are entirely exposed in the open field. When we surveyed 10,000 Australians earning between $110,000 and $130,000, a staggering 78% of them admitted to this exact feeling. The sensation of running on a treadmill that is slowly catching fire. This is where the system penalizes you for trying to live. If you don't have private health insurance, the ATO hits you with the Medicare Levy Surcharge, MLS. It is an explicit punishment, a financial slap in the face for daring to earn a good wage without playing their bureaucratic games. The escape mechanics. At $120,000, you must stop taking the tax hits passively. You must play defense. First, calculate the exact cost of basic hospital cover versus the 1% to 1.5% MLS penalty. Usually, buying the absolute cheapest junk hospital policy is mathematically superior to paying the ATO surcharge. Second, this is where you start buying assets that produce deductible debt. If you buy an investment property or a parcel of dividend-paying ETFs using a margin loan, the interest you pay becomes tax deductible against your $120,000 salary. You use negative gearing not to lose money, but to convert your highly taxed wage into wealth-generating assets. You begin weaponizing your debt. Level 4, $250,000. The awakening. The letter arrives in the mail. It is crisp. It is formal. It is from the Australian Taxation Office. You open it. Division 293 tax assessment. Because you crossed the $250,000 threshold, including your super contributions, the ATO has decided that the standard 15% tax rate on your retirement money is no longer fair. They demand an extra 15%. They reach directly into your future and take another slice. At $250,000 a year, a profound psychological awakening occurs. You suddenly realize that earning a high income is a trap. High income is the most aggressively taxed, heavily monitored and painfully penalised form of wealth in Australia. You look at the sheer volume of paid tax on your group certificate. It is enough to buy a brand new European car in cash every single year. You feel a deep, burning resentment. You are working 60-hour weeks as a senior director or a medical specialist, sacrificing your health and your family, and the government is taking nearly half of your marginal effort. You realise you cannot work harder. You have hit the ceiling of human labour. The escape mechanics. At $250,000, you stop focusing on your salary. You start focusing on debt recycling. You realise that paying down your non-deductible home loan is mathematically inefficient. Instead, you deploy the Peter Thornhill approach. You draw down equity from your principal place of residence. You use that equity to buy income-producing, fully franked Australian shares. Because the borrowed money was used for investment purposes, the interest on that specific loan split becomes tax deductible. You begin aggressively converting your bad home loan debt into good tax deductible debt. You generate franking credits, tax paid by the companies you own, which wash against your massive personal tax bill. You stop working for cash, and you start forcing your balance sheet to work for you. Level 5. $1,000 the architect. A fundamental shift happens at $1 million a year. You no longer earn money. You direct it. The anxiety of paying bills is a distant, foggy memory. You do not look at price tags. You do not care what petrol costs, but a new emotion takes over. Paranoia, protection. You realise that having $1,000 attached to your personal tax file number is financial suicide. If you are sued, if your business goes under, if the market turns, you lose everything. So you become an architect. You walk into your accountant's office. It smells like rich mahogany and expensive espresso. There are no forms to fill out. There is only a whiteboard. You separate your physical self from your financial self. You do not own the money. The money is owned by a discretionary family trust. You are merely the appointor. You control everything, but you own nothing. The ATO is no longer a predator. The ATO is simply a set of boundaries, and you have hired the best map makers in the country to navigate them. The escape mechanics. At $1,000, your income flows into the family trust. At the end of the financial year, you act as the puppet master. You distribute the income to a corporate beneficiary, a bucket company. Instead of paying the top marginal tax rate of 47%, the bucket company pays a flat corporate tax rate of 25% or 30%. You just legally saved hundreds of thousands of dollars in a single afternoon. The wealth stays trapped inside the corporate structure, compounding year after year, completely insulated from your personal tax return. You have built a fortress. Level 6, $5,000 and $1,000. You do not exist. At least, not to the retail banking system, and barely to the standard ATO algorithms. Wealth at this level is not flashy. It is not Lamborghinis or Gucci belts. Wealth at $5 million a year is silence. It is vast, unbothered distance. You don't have an accountant. You have a family office. A dedicated team of lawyers, tax agents, and investment managers whose sole full-time job is managing your bloodline's capital. The ATO is no longer an authority figure that dictates your life. They are a counterparty. When you do a transaction, your lawyers request private binding rulings from the Commissioner of Taxation beforehand. You literally ask the government for permission to pay a specific amount of tax, and you negotiate the terms before the money even moves. You are certified under Section 708 of the Corporations Act as a wholesale investor. Retail investors are fighting over 4% term deposits. You are quietly injecting private credit into commercial property developments, earning 12% backed by first mortgage security. You have won the game. The board has been flipped. The escape mechanics. At $5,000, mechanics are bespoke. You utilize offshore tax treaties. You establish holding companies in zero tax or low tax jurisdictions for international expansion, entirely legally, under the watchful eye of top-tier legal counsel. You use charitable foundations not just for legacy, but to manage taxable estates and exert philanthropic control. Your wealth is no longer measured in dollars, it is measured in generations. The great irony of the Australian financial system is that the harder you work as an individual, the harder you are punished. The system is designed to tax labour to the absolute brink, while aggressively rewarding those who own capital, utilise debt, and structure their entities. You cannot outwork the ATO, you can only outstructure them. But once you've built the trusts, utilised the debt, and bought your freedom, what happens when the ultimate Australian tax shelter, the property market, starts to quietly cannibalise itself from the inside out? We'll break down the hidden collapse of Australian real estate in the next video.